This morning, the Biden administration has announced that it is automatically forgiving $39 billion in federal student loan debt for thousands of borrowers.
We made a commitment to fix our broken student loan system.
Why are we punishing millions of people because they chose to get an education? That makes no sense.
I mean, the numbers are so unreal and astronomical that I can't even fathom making a payment.
As the cost of college education continues to increase in the United States, reliance on student loans has intensified, which burdens a generation of students with substantial debt. This has sparked a significant crisis, which not only challenges the accessibility and affordability of higher education, but it also stirs debate over the sustainability and relevance of college education in an ever-changing job market. How did we arrive here? What does this mean for the economic and psychological well-being of millions of current and former students? In this video, I'll unravel the historical decisions that have shaped the current state of student loans in the U.S. I'll examine their profound impacts across different demographics, and I'll discuss potential reasons for the increase in debt levels. Welcome to Humanitas Academia, where I discuss various aspects of college and university education. If you find educational content interesting or helpful, please like, share, and subscribe. Now, let's begin. Student loans have been a cornerstone of higher education in the U.S. for decades, with the most recent debates bringing their benefits and drawbacks into sharper focus. The original loan system began in 1958 with the National Defense Education Act, but it was the 1965 Higher Education Act that truly laid the foundation by establishing the Federal Family Education Loan Program. This act expanded access to government-subsidized loans, grants, and work-study opportunities. From here, the system continued to evolve with the introduction of additional grants and loans in 1972 and 1992, which both broadened loan eligibility. A significant shift occurred in 1993 with the creation of the William D. Ford Federal Direct Loan Program, which allowed students to borrow money directly from the federal government. This moved loans away from the reliance on private lenders, as this was the norm in the past. This new program significantly expanded the availability of student loans. In 2005, the government passed legislation that made it nearly impossible to discharge student loans through bankruptcy, thereby increasing the long-term financial burden on students. This change has significant relevance to the student loan conversation happening today. The previous program, which offered government-subsidized loans, was discontinued in 2010, requiring all federal loans to be directly issued through the Direct Loan Program established in 1993. By 2013, the Student Loan Certainty Act tied federal student loan interest rates to the financial markets. While this initially resulted in a lower interest rate for new loans, it also introduced the potential for rates to rise over time as rates increased. This change is also a significant factor in the current student loan crisis, as interest rates in 2024 are substantially higher than they were in 2013. Finally, between 2021 and 2023, discussions on student loan forgiveness intensified, with the Biden administration introducing various proposals, including the cancellation of some student debt. The evolution of student loans in the U.S. has been marked by significant legislative changes and policy shifts, which culminate in a landscape that profoundly affects today's students. From making it nearly impossible to discharge student loans through bankruptcy to tying student loan interest rates at the financial market, it becomes clear that the past is deeply entwined with the current challenges faced by current students. Considering the economic shocks of 2008 and 2020, it is not surprising the millennials and Gen Z moving through the system have felt significant present-day consequences. Now, we move from the historical origin of these policies to the current state to examine how these historical developments have set the stage for today's student loan crisis and what this means for millions of Americans who are currently navigating the educational and financial future. As of the second quarter of 2024, student loan debt in the U.S. stands at $1.74 trillion. Interestingly, this marks a slight decrease from the peak of $1.76 trillion in late 2022. Currently, there are 42.8 million Americans with outstanding student loans, which is also a decrease from a 2022 high of 43.8 million. Let's consider these numbers in a broader context. Approximately 20% of American adults with an undergraduate degree are carrying student loan debt. Each year, about 32% of undergraduate students in the U.S. take on new student loans, which contributes to roughly $100 billion in new student loans issued annually. Take a moment to consider these figures. On average, the student loan debt amounts to $37,000 per person. The median debt stands at $19,000. Why do you think there's such a significant difference between these two numbers? What does this tell us about the distribution of student loan debt among borrowers? The difference between the mean and the median suggests that there are students with a very high debt amount that is pulling the average up. Furthermore, there are likely a significant amount of people with relatively low to moderate debt amounts, but a smaller number of individuals with very high debt. Therefore, the median figure is a better indicator of the quote-unquote typical experience, as it is less affected by extreme values that drag the average up. The median also tells us that half of borrowers owe less than $19,000, which is a more realistic overview of typical student debt levels. Notably, the demographics of debt holders vary significantly, which reflects deeper socioeconomic patterns. According to the Federal Reserve, the average student loan balance owed by each age group is as follows. Again, take a moment to consider these figures. Why are the debt levels increasing by age group up to the 40 to 49 years old bracket? This is likely because as individuals age, their student loan payments can accumulate interest. Certain repayment plans may not cover the interest, and therefore individuals are not repaying any of the debt on the principal of the loan itself. Therefore, the loan increases.
I, at this very moment, owe $99,000. It finally dropped under $100,000. And I have paid back on the federal loans over $186,000. So I have paid back nearly twice what I originally borrowed.
The 2013 Student Loan Certainty Act, which tied federal loan student interest rates to the financial markets, is certainly a factor here. While this may have seemed beneficial in 2013 when interest rates were at an all-time low, rate increases since then have driven up interest payments on the loans. As such, individuals are now becoming aware of how little progress they are making on their loans, which may have occurred well over 10 years ago.
When I graduated from medical school, my total education debt was somewhere around $225,000 to $250,000. So 9 of the last 10 years, I've been making payments, but the debt has now ballooned to $355,000.
Other demographics of note are that 66% of the student debt total is owned by women. This is not particularly surprising, as in the US, women make up around 58% of the higher education population. There is also variation in average amount borrowed by race or ethnicity. Black students borrowed an average of $58,000, which was higher than the average amount borrowed by those who were Asian or 2 or more races, white, Hispanic, or American Indian, Alaskan Native. What is very interesting about this data is that the average amount owed as a percentage of the amount borrowed also showed some variation by race or ethnicity. The average percentage owed was lower for those who were Asian and higher for those who were Black. Black bachelor completers were the only racial ethnic group whose average amount owed 4 years after graduation was greater than 100% of the amount borrowed. That is, on average, Black bachelor's completers owed more 4 years later than the amount they had originally borrowed. This is likely due to some of the factors noted above, where interest is accruing faster than the payments on the principal of the debt. Why this is present in the Black population more than the other racial ethnic categories is a topic for another video. The student debt crisis has long been a subject of concern, well before the recent discussions on debt forgiveness. Scholars have drawn parallels between this issue and the 2008 mortgage crisis, where loans were issued without proper assessment of a borrower's ability to pay, leading to widespread defaults when housing prices started to crash. Despite a decrease in default rates since 2010, the total amount of student debt continues to rise, raising critical questions about government policies on student loans. This begs the question, why would the government want students to take on more debt? Why would they approve people for loans who may not be in the position to pay them off efficiently? Here are some possible explanations. Typically, college education leads to higher earnings for individuals. This in turn leads to more tax revenue. Over the course of an average lifetime, a 4-year equivalent degree gives the government $470,000 more in income tax, property tax, sales tax, etc. This is typically twice as much as the government would collect in lifetime taxes from a high school graduate who lacks a college degree. Also, someone with a 4-year degree typically leads to lower spending on welfare programs, Medicare, supplemental security income, unemployment compensation, workers' compensation, prison costs, and medical care of the uninsured. These savings have been calculated over an average lifetime to be conservatively almost $85,000. This equates to the government getting back at least $7.50 for every dollar it invests in a college student's education. In other words, the return on investment is amazing from the government's point of view. Furthermore, there is interest on the debt, generating more revenue. All of these considerations are only measuring the direct fiscal return from college education. This is not even accounting for the economic growth that may be associated with a higher educated population. This environment has led some scholars to suggest that the escalating student loan debt is a form of state crime or social harm, given its profound psychological impact on students, especially millennials and Gen Z, which hold most of the debt. I tend to agree that the social effects of ever-increasing ballooning student loan debt is a significant problem that has a long and far-reaching effect beyond the obvious fiscal pressure placed on individuals. Carrying this level of debt may affect people's willingness to start a family or to take more risky jobs, and will certainly delay them owning a home. Therefore, it is possible that the current student loan crisis contributes significantly to a variety of other social issues across the country, such as falling birth rates and various economic strife. As noted by one scholar, college education may be the riskiest expenditure for many households, given the unstable job market and increased financial risk if graduates cannot secure satisfactory employment. Despite the fiscal payoff of education, public investment in college education has fallen despite ever-increasing college budgets. In 1984, nationwide net state funding for higher education was 4.1% of total state government spending. In 1994, it was 2.4%, and in 2004, it was 1.8%. After the 2008 fiscal crisis, the majority of states cut back their direct investment for public universities and colleges even further. When public institutions have less funding, they are likely to pass costs on to students in the form of tuition increases to keep up with research, marketing costs, and an ever-increasing bloated human resource pool. Over time, this has resulted in the average annual tuition and fees at public four-year institutions to increase dramatically. This is also the case with private four-year institutions, which typically have a much higher tuition cost. The result of these increases in tuition are the need to take on more debt to cover costs. Only recently, as of 2020, has the average public higher education funding increased for 8 years in a row, where 18 states have brought funding up to the pre-2008 level. However, I am doubtful that this increase in funding will be passed on to students in terms of lower tuition. As we've explored today, the student loan crisis in the United States is not just a fiscal issue. It's a deeply embedded social and economic challenge with far-reaching implications. The escalating costs of college education, coupled with decreased public funding, has created a system where students are increasingly burdened with debt that can take decades to repay. This has profound consequences not only on individuals, but also for American society, influencing everything from economic stability to social behavior. Addressing the student loan crisis will require a comprehensive reevaluation of the approach to funding education and supporting students. In an upcoming video, I'll be discussing solutions to the student debt crisis, covering debt forgiveness, as well as market-based and policy-based solutions which may alleviate the loan burden and create a more sustainable system for future students. Thank you for joining me on this deep dive into the student loan crisis. If you found this information informative, please subscribe to Humanitas Academia for more.